Today, as you all are aware, we're talking about finding your first deal. So, obviously, a pretty broad topic, but we're going to try to give some actionable advice. Chris and I have seen a lot of deals, um, in our time here at passiveinvesting.com. I have purchased a deal on my own, so I know what it's like to go through that process and everything that you kind of need to figure out. So I think hopefully we'll be able to add some value, to you guys, and certainly open to any questions that you guys want to put down in the chat box or anything like that, and we'll try to get to as many of those as we can. So Chris, you want to start, I guess, with market stuff?
Yeah, absolutely. So I'm reading Finding Your First Deal for Apartment Syndication. Maybe you guys are here for not only syndication, but just doing a deal on your own, whether that's a duplex, triplex. I think a lot of this will relate to that as well. But just to cover what a syndication is, you may not be aware. That's just pooling a group of people together to raise equity in order to purchase an asset. Usually this is done for larger acquisitions such as multifamily. So the first question would just be how to select your market. I think so. Basically, there's so many markets within the United States alone where you can be successful in multifamily or single family, whatever you're looking to get into. But the way we're focused in the Southeast, and the way that I guess we'll cover how we go about our market selection, and we set criteria and goals for ourselves. I think it's very important to limit regions or markets, maybe even submarkets of that matter, in order to be successful and not be so broad. And the way that we do that, and I think Eric can build upon this, is figuring out the economic drivers within each market, whether that may be employers, hospital, basically employers, of course. So the larger employers, for example, like I said, we're in the Southeast. So we're in, I believe it's Raleigh, is where Apple has been relocating to. So that's a huge economic driving force that will create many jobs and therefore require housing. So we look at things such as that. And then we also set other KPIs or key performing indicators that we look on a deal by deal basis. So yeah, Eric, do you want to build upon our criteria and why we search for what we search for?
Yeah. So we look at median income of the area. Typically, we like it to be above 3 times the average market rent of the deal that we're looking at. So affordability is a big factor. We want the people that live around the area of the property to actually be able to afford the rent. And we also look at that on a pro forma basis. If we're doing renovations, we say we can get, a $200 a month rent bumps. We want to make sure that we're not, pushing that rent amount above the income demographics of that area, because you don't want to alienate, our tenant base there. So we look at, population growth, job growth. We have CoStar, which is a good kind of source for that kind of information. A lot of times up front, we'll do a kind of a Google Street View of, the area if we're not actually in that market. Just kind of, like we're driving around the area, just go on Google Street View and take a look at kind of, what's the nearby retail, what's the nearby kind of major thoroughfares and roads that people are kind of seeing your asset on. So those are a couple specifically of kind of what we look at, but as far as finding your first deal, I would say it's going to be easier to buy where you live, so in your backyard. I understand that's not possible for people that are maybe in Orange County, California, or Los Angeles, like some of the people that we have in the chat. So if that is the case, it's certainly possible to invest out of state or out of market. You just need to kind of build out your team, or be willing to travel frequently to that market in order to build those relationships and things like that. Um, but as far as selecting your market, I feel that being in your own backyard, you're always going to have a leg up and kind of a competitive advantage because you know that market. You're able to go meet the brokers for lunches and do the kinds of things that you wouldn't be able to do if you're investing in Florida and you live in California type of thing. So yeah, that's a little bit about selecting the market. I guess we can move on to, unless Chris, you have anything else in markets?
Yeah, I just want to show them quickly this CoStar page. I'm not sure if anyone's familiar with CoStar. Software, it's a little bit, it's pretty pricey, but we're fortunate enough where we have access. But this actually has a collection of both demographics and analytics that gives us valuable information, just things that are like household income, medium household income, basically everything you can possibly want. This has access to. So this is something that we use. I know that there's other softwares that are cheaper, and all it really takes is a Google search to find good, valuable information that can help you determine what markets that you want to be in. So yeah, I think we can move on to how to choose an asset class and deal size. I can tell you our criteria was based on basically what we can perform based on an equity standpoint. So most of our deals are leveraged. We use debt to leverage our deals, and basically finding out at what level can you put down on your own with your own equity to determine the size of a deal, whether that's a single family home or a 150 unit complex such as we do. It's very important to know your limits, and a big part of that is knowing your net worth, and whether you have a team or you're by yourself, that can be a group effort. So yeah, Eric, is there other things that you can build upon on choosing the asset class and deal size?
Yeah. So yeah, deal size is definitely going to be an equity question. If you don't have the net worth, there's things that you can bring in a key principal who can sign on the loan for you in exchange for a percentage of the partnership. So there are ways to get around it, as well as partnering up with people that have money or have the net worth. That's what I did for my first deal, was sought out two people that had a significant net worth and significant cash reserves. And I found the deal, managed the renovation, managed the project, and kind of negotiated the deal up front. And then they came in and filled the equity and net worth buckets of the partnership. So there's certainly ways to get around different kind of limitations that you might run into. As far as asset class, um, it kind of depends on your goals. So with us, we're going after institutional quality assets at this point, because cap rates between Class C and Class A deals are not, we feel, are not risk adjusted for buying a Class C deal versus a Class A deal at roughly the same cap rates. So that's a decision that we've made because we feel that those are a little bit more secure of an investment at this point in the cycle. Um, that's not to say that there aren't good Class C deals out there. I just think that you have to work a little harder to dig those up at a decent cap rate. So yeah, I mean, choosing an asset class, that's kind of depends on your goals and depends on even what kind of properties are actually in your area that you can go after. If you're investing in your backyard, sometimes you're limited to that. Um, but that's just a little bit about asset class and deal size.
Yep. Um, so if you guys have any questions, please feel free to continue to type them in this chat box. Eric and I will definitely cover those. I see some of them coming in currently, which we can definitely answer for you. Um,
Okay.
the question is, Eric, I might ask you this one. I'm a mortgage broker licensed in multiple states. So would you advise I focus my markets to those states since I'm already networking with brokers in those markets? I think that's a good lead into our next topic here, which is tips for building your broker network. So what would you tell? I believe that was Kevin here that asked that.
Yep. Yeah, that's definitely a competitive advantage that you have if you're already networking with selling brokers, with investment sales brokers. So yeah, I would say, focus. I would say focus on those relationships. Of course, the answer to these questions is always going to be it depends on a lot of things. I mean, are the brokers that you're networking with located in San Francisco, California, where it's not likely that you're going to find a good deal, or are they based in the southeast where there's a strong business environment, there's strong migration patterns, there's strong job growth and population growth. And I would say that is just another reason why you could focus on those states. But yeah, I would use every competitive advantage that you have. So that would make sense to me if you wanted to focus on the areas that you already have relationships in, for sure.
Great. Um, yeah, which leads us into tips for building your broker network. I think Eric's our first point of contact for our acquisitions team. So he is building these broker relationships out throughout the Southeast, as we discussed. And I think he has a lot of insight on that topic. But I can tell you from a person that's kind of breaking into this role currently is it really just comes down to personal relationships. It's how well you build this personal relationship with this person or this broker or this team, meaning boots on the ground, face to face contact, constant communication, not to a point where it's annoying, but to a point where you're comfortable and you can express things clearly and honestly. And a lot of deals come our way just through these personal relationships that Eric and Brandon and myself have built out. Um, yeah.
Yeah, there's kind of a veil that gets lifted as you actually build a relationship with these people, because they have potential buyers reaching out to them all the time, and I think they all have to put up a bit of a wall at first just to kind of vet you and see if you're serious, and see if you kind of know what you're talking about. So that's why it's important to learn the terminology and things like that. So after you kind of get past that first level of the vet of the broker, you'll notice, especially when you get in front of them and get your face in front of them, you take them out to dinners, lunches, it becomes a lot more personal, and you're able to talk a lot more candidly about certain deals and certain markets, which is how you get off-market deals or limited listing deals. You kind of get on their list of top buyers, which has been powerful, definitely for us. Um, the big thing is going to be FaceTime with these brokers. So that's one of the reasons why we're kind of building out a regional focus, because with our small team kind of handling all the broker relationships in the Southeast United States, it gets a lot to maintain all those relationships and make sure you're following up on deals that everybody's sending you, as well as just calling these people just to have a conversation a lot of times. So I would say for finding your first deal, that would be another advantage of investing in a market that you're close to, is being able to get in front of these people a lot, ask them to lunches, and just kind of, like I said, getting behind that kind of first wall of defense, and just introducing yourself, being candid with them about what you think about a deal, what you like about a deal, what you don't. And then they start to learn what your criteria is. And then we start getting phone calls that's like, hey, like this deal is perfect for you. And the reason they know that is because we've given them feedback on what we like, that we don't like. So that's always important. And I think when you're first reaching out to a broker, you want to reach out to them about a specific deal that they're listing instead of calling them and introducing yourself as a potential buyer, because they don't really have time for that. So, do the work up front, analyze the deal that they're putting out, give your feedback to them, explain to them what you like, what you don't like about that deal, and then just keep in touch until you find a deal that actually fits your criteria. I think that's a good way of building a relationship.
I think another point would be is just lower your expectations. Don't expect these brokers to treat you as if someone they know. You know, they're dealing with other groups, hundreds of other groups potentially that are doing similar things. So a great way that we like to stand out is something that's actually on our list here with these brokers is just how we react to a deal that we don't actually get. If we lose, so to say. So if we get to a round of bidding and we're not awarded the deal, I think something that we find value in is just how we react to bad news and bounce back and say, hey, that's okay. Let's look at this one. Or what else do you have? No worries. Like we just have to be as understanding as possible and don't be frustrated because you're not their number one for that exact deal. And that happens more times than not.
Yesterday, yesterday
So
we got some news about a
yeah,
deal, and it was just okay. What's another deal that you have, and they sent us another deal that they have, and we'll try to get that one done. So it's never personal. It's just the way things go.
yeah, yeah. I think that was. I think we have some questions coming in here. Let's actually touch on this last thing here. Different ways you can stand out in a crowd, whether that's if you're building up a syndication or just in real estate. This is, as you know, a very competitive space, just real estate in general. So I think being very knowledgeable about, like Eric said, a specific deal before talking to someone or broker or a seller or whomever, and just really have a great understanding of what this is to them, what this means to you, and how it can be a win-win situation. So instead of just throwing a dart in the dark, you need to know what you're doing essentially. And in order to do that, you just have to be consistent with analyzing deals and consistent with your broker networking. And I think a lot of groups do that, but don't do that well. Um, and and being personal, like understanding that these people that you're dealing with are humans. Like, yes, we're talking about real estate, but it really just comes down to relationships and networking and yeah. So also track record is a great way to stand out. So we pride ourselves on that we've never dropped a deal and how quickly we take a deal from under contract to close and simplistic we make that process. So that's something that we differentiate ourselves from other groups is how simple and quick and responsive we can be, especially because we're a smaller team. Well, that's changing, but I feel as if we're very entrepreneurial spirited in the sense that we wear a lot of hats and we understand different functions of the process. So many people can answer the same question, which is a huge benefit. Um, yeah, Eric, would you like to add on that?
No, I think that's great. I guess I see a question here from William. I'm finding Class C mom and pop multifamily properties in the Southeast South Carolina market with asking prices equivalent to roughly a 5 cap, and the owners have a very inflated expectation of value. Are you seeing this too? Yes. We see it all the time. We look at probably a couple hundred deals. Chris, you've got the metrics on that, right? For everyone that we close.
Yeah, we're less than 2%,
Yeah.
I'd say.
So we close on less than 2% of the deals that we look at. Um,
It's probably even lower than that because that's only the deals that we actually analyze with the numbers, but we look at hundreds of more than that.
so of the deals that we actually take the effort to underwrite, look at the numbers, reach out to the broker, we close on 2% of those opportunities. So it's a volume game, I think. Um, there's always going to be there was a deal here in Charlotte that we loved, but the pricing we just could not get to where the pricing was, and we knew the location was awesome. We knew whoever buys that deal is probably going to do very well, but we just could not make the returns work for what we need to give our investors. And so that's just another opportunity that we lost out on. But I think we're doing pretty well this year. So it is a volume game. You need to just analyze a bunch of deals. Um, Owners and brokers sometimes do have a very inflated um, perception of reality in terms of pricing, but that's just how it goes, and that's just how competitive the environment is. So you just have to keep looking at deals and trying to find deals that make sense for you and your investors. But they are out there. You just got to find them. From Lisa, I found an apartment complex near a large university that is for sale. It appears to be a lucrative opportunity. I'm interested in investing if it is a good deal. However, I do not have any experience in the commercial real estate space, only residential, nor the financial resources in the millions to go forward. Where should I start to have evaluated and possibly create a syndication? You can bring it to our group. I would say that's a tough question because it's hard to know exactly where you are at in your journey. Um, you know, Taking down, it sounds like a larger deal. Um, I wouldn't say it's not possible, but I would say that, you would probably, it sounds like in your situation, want to bring on partners or a partner that does have experience in the commercial real estate space and does have the financial resources, to move forward. So, that's what I was talking about earlier, where with my first deal, I brought the deal. So that would be your value add in this situation is, you have the deal. Um, I don't know if it's on or off market, but either way, um, if you can get it locked up and then, as you're kind of going along that process, be reaching out to people, networking, um, maybe bring in a partner or partners that can help you take down that deal. I would not probably try to take it on alone. If you don't have any experience in the commercial real estate space, I think almost everybody I know that got started in this space gets started with some help from either direct partners or they go to a mentorship program. I think it has to start with education and the networking and partnerships in order for you to be able to take a deal like that down. But again, I don't know your whole situation, um, but it's certainly worth a shot.
I think another thing to add on that is starting a syndication group or business happens way before there's a deal, right? You need to create these partnerships or friendships or networking events that you attend way before you present anyone a deal. And that's how our group got started, right? The partners didn't just form together and start buying stuff. They had investors prior to this. They had means of raising equity in order to purchase. There's a lot that goes into starting something just before buying a deal. So I think that kind of plays into your question as well. Just start networking, make some friends in the commercial real estate industry, and talk to them about deals and say, hey, what do you have going on? And say, well, actually, I have this deal. Would this interest you? Something like that can be very valuable.
Yep. Um, got a question from Will. How can you quickly scan a deal to know if it is initial go or no go? We have talked about this so many times, and it's always kind of a work in progress. But obviously, with the volume of deals that you have to look at to find a deal that works, it's an awesome question. It's something that we try really, really hard to get good at. So the question is always, it depends. But for our goals and for our investment criteria, we set up filters with kind of how a deal moves down the chain in order for us to spend more time on it. So typically those filters are obviously markets. So is it in a market that we like? That's A. I guess B would be the size of the deal. So we look at 20 to 130 million or so is our kind of criteria. So does it fit in that price range? Unit count, I guess we, sometimes we'll look at smaller deals if it makes sense, but usually it's upwards of 100 or 200 units. Sub-market, do we have scale in that sub-market? If it's a smaller deal and we already have a larger deal in that sub-market, maybe we make an exception. But I think a qualitative analysis is important to have up front, because you can spend all the time you want on analyzing the numbers and seeing that the returns look great, just to find out that the property is across the street from a liquor store and a strip club or something like that, and it's just never gonna have a good tenant base. It's never gonna kind of make sense as far as location. And vintage, I forgot to mention, so that would be part of how we talked about choosing an asset class. I guess asset class, that meant more of like apartments or self-storage or something like that. I was talking about vintage when I answered that question. But we'll just kind of stick to multifamily because that's what Chris and I know. We do self-storage. That's an awesome business model. We have a fund for that, as well as a debt fund, but we'll kind of stick to multifamily so we don't talk about stuff that we don't know. So yeah, I would say first it's location, vintage as far as what is the year built of the property. We typically look at 2000 and newer, sometimes 1990s and newer. So that's kind of our first level. And then the second level, I'd say if location and vintage kind of checks the boxes, you look at pricing. So what does the broker expect as far as pricing? Right now, we analyze a lot of deals in a lot of similar markets, so we kind of know baseline where pricing should be. So does the pricing make sense? Then we'll do our kind of high level numbers review. So we have a service software. It's called RedIQ. I will type that into the chat. And that is kind of our automated underwriting software. So it might not make sense if you're not looking to scale a larger business, but it allows us to get through the volume that we need to. And so basically it takes the property's financials, uploads them directly into our model, kind of splices everything out, and puts it into the buckets that we like the buckets to be in. So we use that up front. Chris is kind of down and dirty with that side of things. So Chris, do you want to talk about kind of our initial financial review, numbers review?
Yeah, absolutely. That was a good answer to a very difficult question. Like Eric kind of said, there's really no one size fits all, but we're just reviewing how, of course, we do it. So RedIQ, as Eric said, is that software we can dump in financials, and it basically imports it into our model, which is a great way to streamline the process. And then from there, a lot of the times the broker will send an OM, or an offering memorandum, which just gives us a very in-depth overview of the market and maybe the comparables. So we'll just do a quick analysis of that, which will just further, so say we approve it and we like it, then we will kind of go into a creation of a pro forma, or a um, a forward looking projection of what we think we can get out of this asset, which is very complex, and it's again not a one size fits all. But so we'll create a pro forma, and then from there, if it's a go from there, then we will link up with our property managers, and we'll have everyone to be on the same page. And if everyone's on the same page and feels comfortable with the underwriting, then we will continue to the bidding process. Well, of course, we'll tour the property, but that's kind of our, um, I guess, how we disqualify a deal, very briefly. But yeah, um, yep.
Teresa has a question here. If we bring the deal to potential partners, how should we calculate the profit splits? I know there's resources out there as far as like different breakdowns on how it should be split up. It depends, as Brand. So yeah, that's something that I think you should just be pretty relatively open, assuming you have a good relationship with your partners, which I hope you do. You should be able to have a pretty transparent conversation about what the value everyone is bringing to the table is and what that value is worth in terms of the splits. I can't really say a whole lot more than that without knowing exactly what the situation would be, but it's always just going to be a transparent conversation with your partners. There are general rules of thumb out there that I don't have off the top of my head, but I know. And again, talk to other investors, see how they're structuring things, see kind of how they're splitting profits. I know with us, we do a 70-30 split. So 30% of the deal is a general partnership, which is our company. 70% is our investors. We pay our investors 7% preferred return in the Class B structures. We also have Class A investors who get a 9% preferred return. Those Class A investors do not participate in the upside. The Class B investors do. So that's kind of the general profit split that we have with our investors. And I know there's tons of ways to structure that. So that's just kind of how we do it. So I see we've got a question in the Q&A box. What are the big metrics you look at when underwriting? So we look at IRR and cash on cash as far as return metrics. So yeah, that's typically what we're targeting on an IRR is a low to mid-teen IRR, and that's on our Class A institutional type properties. And we look at 6 to 7, usually 7% on our cash returns on that as well. So that's kind of the return metrics. And then how do we justify our assumptions when underwriting? We don't use broker pro formas to underwrite. So that's a big thing. We make our own pro formas by seeing a lot of deals in markets, talking with our property management company on their assumptions on expenses in the market, how they would run the deal. So we do a lot of market research, which Chris is looking at right there on CoStar, and we just try to get really in depth on the trailing financials and see kind of how we can be defensible in our underwriting. We're not, if you're always super conservative on every single aspect of an underwriting, you're never going to win a deal. So, we are, I feel, conservative, but we're also defensible in the things that we think that we can achieve. And there's, data to back that up as far as rent upside, any kind of operational efficiencies that we can have from how the sellers are operating the deal versus how we are operating the deal. So that's a little bit about the assumptions. Chris, and you on that?
Yeah, I think a big part of, well, especially multifamily, are your pro forma rents. And a great way that we justify our rents is by calling up the comparables. I literally call each individual property that we find to support the asset at hand, and I'll say, hey, what are the rates that you're getting for a 1 bedroom, 2 bedroom, 3 bedroom? And I'll, we're young enough where we can sound as if we're actually looking for a property, but it's we're in the markets. Eric's touring those assets while I'm calling them up on the phone and getting, daily rates. So there's a lot of legwork that goes into it. It's yes, it is an assumption, but it's very accurate, we feel, and conservative. Um, so yeah, I hope that answers your question.
Yeah. What is the loan to value you are seeing on your deals on refinance? So we have not actually refinanced very recently with how the market is. We have found more value in actually going full cycle as far as selling a few deals recently. So we have not done a refinance. I know on the 12 unit that I bought, we got a 70% loan to value on the refinance out of the construction loan. So that could be a data point. But as far as refinances, we have not done a large one recently. So that's the only kind of data point I have there.
Awesome. I don't see any more questions. So I hope everyone found value in that. Um, if you'd like to reach Eric or myself, I think some of our contact information is on the webpage. And again, feel free to check out the website, the Multifamily Investor Nation Summit, which again is in January. And yeah, we appreciate your time, and we look forward to seeing you next time.
Yeah. Thanks everyone. Hope it helped.
Bye.